All attendees are in listen-only mode.
Good morning, everyone, and thank you for joining us for today's free webinar, Lean Cash Flow, Simple Steps to Better Startup Cash Management with Cirque Rowe of Early Growth Financial Services. My name is Gina Longmire, and I'm the Marketing Manager for Early Growth Financial Services, and I will be your moderator today. This presentation will run about 40 minutes. If you have any questions as we go along, please feel free to enter them in the question field or tweet them to us at earlygrowthfs with the hashtag LeanCashFlow. Don't just raise your hand, jump right in with your questions, and we'll answer them as they come. If we can't get to them, we'll save them until the question and answer period at the end of the presentation. If we run out of time, we'll follow up with all of your questions individually, and you will also receive a follow-up email tomorrow with a link to the deck and the recording. Now it's time to meet our panelists. We have with us today Cirque Rowe. Cirque is the Chief Operating Officer for Early Growth Financial Services. Cirque has 25 plus years of financial experience, with 17 years serving in financial leadership roles in high-tech companies. He's an accomplished finance executive focused on leading early-stage companies through strategic financial decisions. Before we get started, I was hoping Cirque could tell us a little bit about Early Growth Financial Services.
Sure. Thank you very much, Gina, and hello, everyone. Good morning, and for those of you on the East Coast, good afternoon. Happy Halloween to everyone. Thank you very much for taking time this morning and afternoon to spend a little bit of time with us. We'll be talking about cash flow management and especially for startups. A little bit about Early Growth. We are a national outsourced finance and accounting service firm, and we work with small and medium-sized companies who don't necessarily need to or want to hire people internally, whether it's for cost reasons or just because they want to stay lean themselves and want to use an outsource model for lots of services. We are a great partner for firms like that. We do basically 4 types of services. We do corporate tax returns. We do 409A valuations for companies who are offering stock options to their employees. If you're doing that, you should be doing a 409A valuation on an annual basis at a minimum. We do transactional bookkeeping and accounting. So that's the day-to-day, week-to-week, month-to-month accounting, including full GAAP compliant, accrual-based financial statements with full balance sheet account reconciliations. And then finally, we provide CFO level services. And that would be for higher level things like budgeting and putting together financial plans and looking at cash flow analyses and cash flow forecasts, helping with fundraising, helping to possibly look at debt, taking on debt, pricing, any other thing that you would typically go to a finance executive for. We provide that service, and we provide it on an hourly basis, on a go as we go and grow as you grow basis, as opposed to committing a fixed or large amount on a monthly basis. We have 28 CFOs around the country. We have 70 finance professionals, which includes accountants and controllers. We have more than 400 clients around the country, and a few in Canada as well. And we were just named the 13th fastest growing company in Silicon Valley by the Silicon Valley Business Journal. So that's a little bit about our firm. So let's go ahead and get started and talk about cash flow.
Great.
Okay, and I think, and Gina, unfortunately, you kind of broke up there just a little bit during the intro, but I think one of the things that you were trying to say that didn't come across was that, for anyone out there, as we're going through this this presentation, feel free to ask your questions. Go ahead and type in questions in the dialog box, and Gina will monitor and stop me and ask questions. So feel free to ask questions along the way.
Yes, definitely.
But this is what we're going to be talking. This is what we're going to be talking about today. So we're going to just talk about kind of what we mean when we say lean cash flow, and it's really about understanding kind of where we're spending money and being able to adapt. That's really the biggest thing. It's okay to make changes. We are going to be making changes to the company, to the product development, to the customer acquisition strategy, and certainly to the lean cash flow model, but it's really important for us to understand exactly how we go about doing it and the timing of it. We'll talk about making assumptions and how really the assumptions should be driving the model and should be driving how much cash you're using. We'll also be talking about how we actually go about modeling and the different ways that we would model cash flow, whether you want to take a very detailed approach, or whether you want to take more of what we call a hybrid approach, and we'll talk about the differences between the two and when it makes sense to do one or the other. We'll really spend a lot of fair amount of time in understanding your cash flow, and also finally we'll talk about what we can do to actually better manage cash flow. It's going to be very critical as you start, whether you are a self-funded company or whether you are getting external financing and using other people's money. But it's really important, as you are probably already aware, that we manage properly, that we plan properly, and that we are always aware of what's happening with our cash. So we'll talk about those things. So what is lean cash flow? And we use lean cash flow as just kind of like an offshoot of there's a book called The Lean Startup by Eric Ries, and this is a book that has received a lot of attention because it really does actually put into a process, step by step, what entrepreneurs can do to really maximize your chances of success. As you know, most startups fail, right? And a lot of the reason why a lot of startups fail isn't necessarily because they didn't execute, but a lot of startups fail actually because of the fact that there's a misunderstanding of what the customer needs, and so companies will they get a great idea, a founder gets locked in on an idea, starts developing that idea without really understanding how critical this idea, this product or service is to the customer base, and so they will spend a lot of money and time developing a product, only to find out afterwards that the demand wasn't as great as we thought there was, and that actually causes companies to fail much more so than actually lack of execution. And so the lean startup really talks about putting together a process and a methodology of understanding kind of how would we go about developing a product to fit what customers want, and then adapting, learning, and adapting to changes, and as we find out more about what our product is doing and how it's being accepted by our customer base in making changes to our product, pivoting away, and hopefully getting better and better as we go. And so, the lean cash flow really is kind of an offshoot of that, where we basically apply those principles, and we do the same exact thing. So it's about being open-minded. It's about learning and adapting. It's about using assumptions, building a model around those assumptions, testing those assumptions, and then as we get more and more information, in adapting and making changes to our model and changes to our assumptions, so that as we look forward, we're going to be better and better at it, and hopefully be able to manage our cash better. And so this whole idea of building a model or building a product, measuring it, how is it being successful? Where is it not being successful? Learning, that whole feedback loop, which results in us pivoting the way that we think about our company, about our cash flow, is really the key. So let's go ahead and talk about the cash flow projections. So, especially at an early stage, obviously, if you have a history, so if you've been around for a little while, you already have expenses that you are incurring, then obviously we should be using that as kind of the initial template to build our model. Many of us, especially early on, we don't know, right? We don't know what we're going to be spending for customer acquisition. We don't know how many employees we're going to need and when we're going to need those employees, and even how much we're going to have to pay these employees. We don't know how much contract work we're going to have to spend. Hopefully, we probably have an idea, and maybe it's on the CapEx side. If we're a development company, the CapEx isn't going to be that strong or that large. If we're a product company, obviously there's more involved, but obviously if there's a history, use it. If you don't have a history, then at an absolute minimum, there's a lot of information on the internet. There's lots of sources that you can go to where you can look at industry examples, right? And you can see some histories and you can see filings from companies about kind of, the percentages that are being spent for headcount, for example, or R&D or sales and marketing. And you can use some of those examples and comps or comparables and use those as a starting guideline. And then, the big thing that I really focus on here is to say that we should be focused on assumptions, because the entire model should be built upon assumptions. So, you're going to, like I said, we're going to be making lots of pivots, and we're going to be updating the model regularly. I encourage you to, if you can, if you have the wherewithal, to build a model that is focused on assumptions, so that when you go ahead and change those assumptions, as we will, then it'll be very, very easy to update the model as we go along, as opposed to you having to go in and every single time there's a change in the way that we're looking at this, you have to spend hours and hours and hours updating the model, because you've been just putting in kind of detail in there. So that's not the way to do it. The way to do it is to focus on the assumptions and then build a model around those key assumptions. The other thing about assumptions, and you'll find this as you kind of work towards all the variables, and we'll talk about this a little bit more a little bit later, but you'll find that there are probably some key ones. There are some key variables and key assumptions that really, really will drive the model, and it's probably things like revenue, and it's probably things like headcount. So on the expenses, headcount and consulting services are probably going to be amongst your biggest spends, as well as on the revenue. Obviously, what you model out for your revenue will be really, really key. And then on the expense side, it'll be headcount, it will be customer acquisition cost, and it'll be consulting fees. And those are kind of big key drivers that will drive it. And we'll talk about how we go ahead and look at that as we go forward. So so as we talk about, I'm sorry. Yeah, thank you very much, Gina. So when you don't know what those assumptions are, what I would encourage you to do is ask yourself some of these key questions, right? What is your business model? What are you developing? How difficult is it to develop? Is it the kind of product that where you have to go out and find customers incrementally, or is it one that can be generated, where revenue can be generated from word of mouth, and where you can see kind of the viral nature of growth? And so those are some of the key questions that you have to ask yourself. You have to ask yourself, how much is it going to take? What level of effort is it going to take for me to develop this product? Is it a simple website where you've got an idea that once you got a simple website up, you'll be able to really start generating some traffic and even some advertising dollars, or even some e-commerce dollars on day one? Or is it something that is like a SaaS, or a software as a service model, where you actually have to build a fair amount of software in advance of you going live? Is it a product? Is it a physical product, where you have to actually build a prototype and then start building product and start generating demand for an actual physical product? So those kinds of questions are obviously critical when you start looking at, okay, how much cost is there going to be? How much cash am I going to need, before I start generating revenue? How will you generate revenue? Will it be about are you going to have to spend a lot of advertising dollars? Are you going to have to do pay-per-click campaigns? Are you going to have to do local advertising? Are you going to have to do national advertising? Are you going to have to hire salespeople? So all of these kinds of questions are the key questions that you have to ask yourself, and the answers to these questions are going to ultimately build out the assumptions that you're going to use to build up the model. Okay, so again, I've already kind of touched upon this, but as I keep on hounding on you guys, obviously focus on your assumptions. Keep your model flexible. This is a key one, and this is where I would encourage you to, if you are spreadsheet and model savvy, obviously the importance of this. If you're not, work with someone who is. You probably have lots of friends, who have built models like this. There's probably examples on the online. If you really want assistance, you can certainly hire someone, but at an early stage, I certainly wouldn't recommend that. I'd be looking to do everything that I can, and run your model by people who know, who can help you navigate through some of the modeling. But keep it simple. Keep it simple, and make sure that it's driven by assumptions, because like I said, you're going to be pivoting. You're going to pivot many times. You're going to be pivoting for all kinds of different reasons, probably reasons that you can't even anticipate at this point in time. And so, as you're learning more, keep on making adjustments to your model, keep on making adjustments to your assumptions, and by doing that, you'll get better and better and better. The level of detail, I think, is important, and again, it should kind of match kind of what you're trying to do, and the importance of each of these detail amounts that you're putting in. If you are if you know that just three or four key assumptions, and you know that that's going to drive 95% of your cash flow, then just focus on those. Don't worry about that other stuff. I'm a firm believer in the 10-90 rule, which is that you spend 10% of your time getting to your 90% accuracy, and then you spend 90% of your time trying to get to that last 10% of accuracy, and level of detail. And I'm a firm believer that, especially early on when you don't know, let's put a model together. Let's do it as quickly as possible. We need something that we can use for our planning purposes, for our fundraising purposes, whatever it is that you're going to be looking at. Maybe you're going to go out to friends and family to look for some money. Maybe you've got the kind of company where you're going to be able to get, you've got some revenue coming, and you might possibly be able to get a bank loan. All those things are going to need financial plans, and cash flow plans that you're putting together. And so focus on that 10% of effort, or 10 or 20% of effort, that will get you the 90% of accuracy. If you really need the level of detail where that last 10 or 20% is going to be critical to whether you're making it or not on the cash flow basis, so then obviously you need to be focused on it. But instead of putting a whole bunch of line items, like for example telephone costs and utilities and office supplies and things like that, I would actually just say put in one number in there for general overheads and office expenses. And then I think that should probably suffice until you start getting some actual data, to be able to put in more data as you need. Iterate is a huge one. So again, every single month that you are actually have actual data, you'll be getting better, you'll be getting smarter, you'll learn more, you'll have more data. And so we should be using an iterative process, so that we're constantly tweaking. And again, if the model is relatively simple, it shouldn't be a huge exercise, but we're constantly tweaking as we find more. And so don't just put together a model, say that I'm making some decisions based upon this, and then put it aside. We see this all the time where we think that the goal of a model is just to give us a snapshot, a point in time, and make sure that that we're making a management decision at that point in time based on this model. And it couldn't be the actuality couldn't be further from the truth. We should be looking at this as an ongoing tool to help us manage our cash and manage our expenses better. And so you need to be iterating. How often you iterate, that's kind of depends again on your company. Depends on what kind of pivots you're doing, how steady state your business is. If you know that, for example, you're going to be spending $20,000 a month, and that's really all you're spending, and it doesn't deviate that much from that, then obviously you don't need to be iterating that often. But if you're spiking, or if you're changing, if you're spending more in advertising dollars, or if you're having to pull in hiring or push off hiring, then anytime we're making those kinds of big decisions, we need to be, reiterating the model. Okay, so let's talk about the different types, or the how we actually go about pulling together a model. And here I would say that there's really two ways of doing it. There's a hybrid way, and there's a full set of financial statements. Let me start with a full set of financial statements on the right side of this slide. And this is where obviously, I, being a finance professional, will always recommend companies do this. There's a lot more data. We can be much more exact, but kind of again, having said that, in many cases, I'm a firm believer in making sure that we have something that, if a hybrid model works better for you, then I would absolutely support that. But really, a full set of financial statements, it includes the income statement, which obviously looks at the revenue, and it looks at the cost of goods sold, and it looks at all of your operating expenses. But as you know, that doesn't necessarily equate to cash flow. And in order to get to the cash flow, you actually have to put together a balance sheet. And so you kind of add a balance sheet onto the income statement, and then the cash flow forecast, it really results from the combination of these two financial statements. If this seems very foreign to you, I highly recommend that you speak with someone who's knowledgeable about financial statements, reading and analyzing financial statements to help you navigate this. But if you really want to understand kind of what's happening from a full financial perspective of what's happening with your company, then this is really the way to do it.
And sir,
the hybrid, yes.
Oh, sorry, not to interrupt you. We do have a quick question. The question is, does CapEx equal capital expense?
Yes, that's exactly what that means. And so let's talk about the hybrid model. The hybrid model basically does this. It basically says, okay, this is kind of the income statement that we see, and then let's make some tweaks to that income statement that really doesn't, that are part of the balance sheet. So CapEx, that's exactly right, capital expenditure. So these are things that you're spending money that are going to give you value over a long term. It could be things like computers. It could be, hard assets. It could be furniture. It could be, things that you wouldn't necessarily expense on day one when you first when you first buy it. Instead, it's going to have a useful life over a long period of time, and so you want to expense it over that useful period of time. But as you know, when you actually spend that money, when you actually buy it, the cash goes out immediately, unless you're doing some sort of a lease. But in many cases, if you're paying cash for it, or if you're putting it on a credit card, as you know, that cash comes out immediately. So if you're only looking at an income statement, you're not going to see that CapEx show up. And so you need to account for things like CapEx. You also need to account for things that are also on the balance sheet that might suck up cash. And what we mean by that are things like working capital. So things like, and this is getting a little bit, probably theoretical on the accounting side, but it's things like accounts receivable. It's things like inventory. It's things that, again, don't necessarily show up on an income statement, but it will absolutely show up on cash. So for example, all things being equal, let's say you generated revenue, but now you've had to invoice a client, and it's going to take 30 or 45 days, and in some cases longer than that, depending on who your client is, but it's going to take you 30 or 45 days to collect. And if that's the case, then basically what's happening is that cash that you should be getting when you first sell your product or service, you're not going to get for 30 or 45 days. It's sucking up cash, right? So that cash is not available. And if you really want to do it right, because we get this all the time. I hear this refrain from clients or prospective clients who come to us and say, hey, Cirque, you know what? I really need some help understanding kind of what's happening with my business, because quite frankly, I don't understand it. We our revenue is increasing, our revenue is meeting our plan, our expenses are actually not growing as fast as our revenue, our expenses are in line. So when we look at the income statement, it looks like we're doing well, but it just seems like we're always short on cash. And this is a classic case of companies that kind of grow themselves out of business. It's absolutely possible to do if you are, sitting on a whole bunch of cash that is not usable, because it's in working capital. So it's in things like accounts receivable. It's in things like prepaid expenses where you had to spend money in front, to put down for deposits for rent, for example. It's in things like inventory, if you have to purchase inventory in advance. These types of things are critical to understand from a cash flow perspective, and being able to manage it, because like I said, we can definitely get into trouble, just by looking at the income statement. And so that's kind of why, if some of these things are big issues for you, then it might make more sense for you to look at the full set of financial statements. Where I would say a hybrid model makes a little bit more sense to me is when kind of the cash flow equates more or less to the income statement. And so that would be for things like if you have a SaaS model, for example, or a software as a service where customers are paying you on a monthly basis, right? So maybe you got it set up so that they put in a credit card, and every single month you do an automatic charge to a credit card, right? And so then on a monthly basis, your revenue really does equate to cash coming in. Same thing on the cost of goods sold. Maybe you just pay a server fee for your SaaS model, to host your service, and you're able to pay that on a monthly basis. And so you're able to match up the revenues and expenses coming in very, very closely. And you don't have a lot of inventory, and you don't have lots of accounts receivable, and you don't have a lot of CapEx. And in those kinds of situations, I think a hybrid model probably is very, very manageable, and in fact is going to be very, very close to being accurate. And you don't necessarily need to be putting together a full set of financial statement projections. Hope that makes sense for everyone. I know that I speak from a knowledgeable accounting base, and so some of those things that I just discussed may seem a little bit foreign to you. And if that's the case, then you're probably like many of our clients or many of our prospective clients who come to us for the first time, who don't understand kind of what's happening with their model. And I encourage you to get in front of it as much as you can. Learn this stuff before you get into trouble with it. Have people who are knowledgeable assist you. Obviously, coming to presentations like this, webinars is a great place to start. There's lots of other places online that you can learn a lot of this stuff on your own as well. So absolutely spend some time learning it, and call people like us if you have more questions, or you want to have more in-depth discussions.
Sir, we have a quick question about a hybrid. Is it also appropriate pre-revenue?
Yeah, absolutely. Again, it kind of depends, So a hybrid model, yes, I would say that pre-revenue is probably a good time to be using a hybrid model where you kind of know what the expenses are going to be. So obviously things like payroll expenses, right, and consulting fees and those types of things are just going to go on the income statement, and then just put on top of that as a bottom, so you kind of see all the cash flow that's going out from your income statement, all the expenses that you're incurring, and then underneath that, just put in amounts for the other types of balance sheet account items that you would add for cash disbursements. So things like CapEx, right? When you need to buy three computers for your 3 employees or what have you, right? Put down $5,000 for three computers, even though if from a classic P&L perspective, you might want to expense that over a 2-year period. If you have to buy inventory, or if you have to put down deposits, right? So for example, a classic one is like when you pay rent for the first time, right? You have to put down a first and last, and even a security deposit, and so put that amount down as a cash out, even though that won't necessarily impact your P&L. So absolutely, pre-revenue is probably an appropriate time to be using a hybrid if those types of additional line items for the hybrid aren't going to be too difficult to estimate. But very, very good question. Okay, so your cash flow forecast, and this chart just kind of, I think we've kind of, talked about some of this stuff. Update regularly, and minimum monthly. I would even say that that's not even necessarily true. Again, you have to kind of determine for yourself, what is appropriate. Absolutely, we have clients, even some larger clients, who do have to update weekly, just because there's so much sporadic spending that's going on, and we're having to watch cash very, very closely. And so if you need to do it weekly, you do it weekly. I think most of our clients, even really early stage clients, are doing it on a monthly basis. But if you really, really have a steady state, and if you know how much you're spending, and it doesn't change month to month, then I think you could even get by with less than that. But typically monthly is appropriate for most clients. And obviously using actuals. So we talked about iterating, but put in actuals, right? So start with a model that says, okay, here's my monthly cash flow forecast, for the next 12, 18 months. Typically, you don't want to go beyond 18 months because it's just hard to understand what is going to happen beyond that. And if you are raising money, for example, you're typically wanting to raise money for an 18-month period. And so 18 months to me is a good model. Some just go with 12 just for ease of just having a rolling 12-month forecast, and that's fine too. But as you do it, put in the actuals, right? So if you start on January 1, you put together a model that goes out through December or goes out through June of the following year, and once January happens, then put that information into the January column, and hard code the entries in, and then look at that versus what you actually had originally budgeted, and to the extent that that needs to be then updated going forward, then update as you need. Always, always, always stay on top of your run rate. Always, always know when you're going to run out of cash. So we use terms like, runway, or time to live, end of life. Those types of terms we use, especially when you're in a venture-backed company. This is a date that you will constantly be updating and communicating to your investors. So if you have outside investors, they want to know several things. They want to know, how's product development coming along? They want to know how are customer acquisitions coming along? And they want to know, how is cash? And are there any changes to the burn or the time to live? Because that is one of the key things that they're looking at. You need to be on top of it. You need to understand it. You can't come up with surprises. So if in 1 month you spent a little bit of additional cash than you intended to, because you just had to get something done, and you maybe needed to hire an outside consultant, and so you burned a little bit of cash, and you did it knowingly, and you did it on purpose, that is perfectly fine. These are kind of the pivots that we're talking about. But understand what that means, and be able to communicate to yourself as well as to any outsiders, whether it's banks or whether it's equity investors. Be ready to have the discussion about what you did, why you did it, and what you're going to do about it, going forward. So are you going to be is this cash that we were planning on spending later on that we had just pull into an earlier period, and so therefore it's just a matter of timing? Or is it actually incremental additional spend that we had to incur that is now going to impact when we're going to run out of cash? So if you have to have that discussion with your investors, I highly, highly recommend that you have that discussion as early as possible, as soon as you find out. You can't hit an investor with a communication that says, remember 2 months ago we talked about the fact that we had 12 months of time, we had 12 months of life on the cash that we have. Now it's 2 months later, and so we should have 10 months of cash, and now we only have 8. That's a discussion that you do not want to have. Trust me, it will not go well for you. It will not be fun. And so as soon as you know that something's happening that's going to impact cash, analyze it, and be ready to understand it yourself and be able to communicate it. Okay, so let's talk about some practical tips, right? And so I think this is probably pretty obvious to you guys, But let's just just go over it. Obviously, we talked about this the close management of costs. Spend money. Spend money wisely. Obviously, we need to spend money. We don't have a company if we don't spend money. But question it, right? Question, not only do we absolutely need it, or can we get by with less, but also question the timing, right? So again, from a cash flow management perspective, the further out that we can push spending, the better off we are. So we may have a plan, and we may have a budget that says that we have so many marketing dollars or so many advertising dollars that we're planning on spending in a given quarter. Well, that's fine and good, but if we're not going to get the benefit out of it, maybe we're a little bit later with our product development, or maybe we're just not as far along the line as we are, or maybe we just maybe we decide this is something that we're someplace where we could save a little bit of money and do it a little bit smarter. Absolutely do it. Push out spending when you can. Cut costs where you can, because I guarantee you there will come times when you get hit by surprises, where you actually have to spend more money, or spend money on something that you didn't think that you originally were going to be spending money on. So every place that you can, question all spending, and push out or cut spending where you can. Depending on the kind of company you have, and how many, and whether there's different layers. Obviously, you want to make sure that the right approval process is in place. If you're the CEO of a company and you've got several employees, or if you've even got a couple of different departments and you've got 10 or 15 employees, understanding when people are going to spend money before they spend money is critical, because once they've made that decision, once they've signed a contract, once they've signed up for a service online, or once they've actually called someone and said and ordered something over the telephone or online, we can't take that back. So make sure that the approval process is in place. Make sure that the right amounts for approvals are in place by the appropriate parties, and implement that approval process, so that we're not, again, getting caught by surprises. If you're a sole entrepreneur, obviously, or if it's just a couple of founding team members, obviously this isn't going to be a critical thing for you. Hiring. So hiring is going to be, probably the area that we spend the most money. And so making sure that we have the right process in place, making sure that we're hiring the right people at the right time, at the right salaries, at the right compensation, is critical. And in some cases, we may be able to do with less. We may be able to do without hiring. Hiring comes with a lot of not only salary expense, but benefits and PTO and lots of overhead. It may come with a recruiting cost if you have to hire an outside recruiter. So it can be a very, very costly venture, even beyond just the compensation. So keep that in mind. In many cases, you'll be able to do more by hiring outside consultants, even if the hourly rate is higher than what you would be paying for the salary of an employee. It still might make more sense for you, especially if you don't necessarily need someone on a full-time basis. Manage accounts payable and accounts receivable. So again, accounts payable and accounts receivable is one of the ways that cash jumps up and down. The more our accounts receivable goes up, the less cash we have. The more the accounts payable goes up, the more cash we have. And so managing it, not necessarily paying everyone on day one. Let's say you buy something, if instead of paying with a check, if you could put it on a credit card, or even better, if you can get account terms, such that we can order something and then they invoice us, and then we can get terms like net 30, or paying within 30 days of purchase. That will absolutely improve our cash flow. Managing accounts receivable, same exact thing. The longer we let our customers take to pay us, the worse off we are. So managing that, both from on the front end, where we are trying to be as aggressive as possible in collecting cash up front. Again, if we can collect by credit card on an automated basis, that's great. If not, then let's try to limit the terms that we offer them. Don't just give in when they say, hey, you know what, I want net 30. Push for net 15, push for net 10, push for cash on delivery. If you have to give terms because it's a key client and that's what they do, then again, making sure that we're staying on top of the collections is really, really critical. Okay, so minding your cash obligations, so I just said that let's make sure that we are not paying people in advance, or that we're trying to do everything we can to push out payables as much as possible. Having said that, it's also very, very critical to manage your vendors properly. So again, if you can set up credit with vendors, push out payment for as long as you can. It's probably going to be hard for you as a small company, but push for net 30, and give yourself 30 days to pay. If you can't, and many of you you won't be able to initially, then put it on a credit card. Credit cards also allow you to push out payment for a little bit of time. The talking about setting up credit with vendors and paying with purchase orders and things like that all have to do with you have to establish credit. So, some of you guys may be thinking, well, what, I've got, the spending I'm doing, it's either employee-based or I just buy small miscellaneous things and I can do it with a credit card. Well, over time, you're going to grow. And the earlier that you can set up credit, a credit history, the better off you're going to be. And as you grow, you're going to get better and better terms, payment terms from vendors if you have a credit history that shows that you've taken on. It's just like your personal credit score, right? The better your credit score is, the more credit you're able to get at better terms. And so for a company, it's the same exact thing. So if you can set up credit early with vendors, why wouldn't you do it? But once we've said that, pay bills on time. So again, kind of the same thing with your personal credit score. If there are things that show up on your personal credit scorecard that says that that you've been late with payments or you've missed payments, it's going to really ding you. And then when you go for credit in the future, it's going to hurt you. Same thing with corporations. So there's things like the Dunn's report, where Dun and Bradstreet is doing analyses of companies, and they're putting together histories, and they're reaching out to vendors and questioning them about your payment history. So people will find out. If you are late with payments, people will find out. So I encourage you to get proactive about it and make sure that you don't fall behind. On the receivable side, obviously the exact same thing. Just put in a system to make sure that payments are being collected as quickly as possible. Don't wait until a client is late to send out notices, right? If you know that you got the net 30 terms with a customer, don't wait until day 31 to send out a, hey, you're late notice. Instead, send out a notice on day 25 that says, Mr. or Mrs. Client, you have a payment due in 5 days. Please remit payment so that we receive it before the terms are up. And you may not get that right away, but every single time you send out these notices, again, you're at the top of mind, and it's going to increase the probability that you're getting paid more timely. And so make sure that you put in a process, and hopefully an automated process, to send out these notifications. Don't let receivables linger. I've seen it happen too many times, and in fact we've experienced it ourselves at times, that the longer we let receivables linger, the less the probability. It's not even just about timely cash management, it's also about the longer that a receivable lingers, the less the probability is that we'll actually collect it, or the greater the probability that it'll turn into a bad debt or bad receivable. And so make sure that we're staying on top of it. These other things like subscription model and use credit cards and automated payments, I think that's probably pretty obvious. If we can do it, we should do it. Okay, so another thing that you should be looking at, depending on the kind of company you have and depending on where you're at, is debt, right? Debt, especially in relation to equity, can be a great source of financing. And there's different types of financing that's available from lending institutions. So debt is, an instrument where you basically borrow some money and then you pay it back over time. And there's different models, different companies out there. There's your traditional bank who will lend you, either give you just a working line of credit, or maybe give you a line of credit based upon your accounts receivable or other assets. Things like accounts receivable factoring, things like asset-based financing, which helps to finance, not only accounts receivable, but things like inventory and CapEx. Those are things that you should be looking at to help you manage your cash flow. And then also there's something called revenue-based financing, where we're basically looking at the revenue flow coming in, especially if it's kind of on a recurring revenue basis. So if it's like a SaaS model where companies or individuals are paying you on a regular basis, there are companies out there who will lend you money based upon that revenue coming in, and you will basically pay a small percentage of your revenue as an ongoing fee to the lending institution. And so it's a way of really managing your cash flow effectively, because there's no like timetable. There aren't big balloon payments that you have to pay to the lending institution. Instead, they'll just take a percentage of that cash that you collect from a revenue basis. And so that's I think a great option for certain types of companies. So be knowledgeable, learn about the different types of financings that are available to you, and take advantage of them. So I think that those are kind of the main things that we wanted to talk about today. But just kind of closing thoughts, obviously, is how much do you have in the bank, and what's your spending like, and what is how long is it going to last you, right? So things like commitments and accruals. And when we say accruals, it's for things like, okay, look, have we committed to expenses that don't even show up? Like, for example, legal fees is a key one that I see getting people into trouble. Lawyers are notorious, law firms are notorious for just not having their accounting and their billing systems really in place. It takes a long time for them to even just kind of calculate the number of hours that attorneys are spending on the different client work. And so many times, as a if you have a lawyer as a vendor, you won't get invoices from them until well after the fact, sometimes 15 days after a month end, sometimes 30 days, even beyond that. And so, but you spent the money, right? You've committed to that money. So let's say, for example, in October, you've sat down with your lawyer a couple of times for either some contract work they did, if you've got some IP, intellectual property that you're trying to protect, you might have done some work with IP attorneys, and let's say you spent that in October. Well, it's not going to show up when you do your expenses, and it's not even going to show up on the balance sheet unless you actually accrue for it. So these are commitments and spending that you've already incurred that you're going to have to pay for in the future, and so you need to make sure that you're aware of it, and to the extent that you can put it down as an accrual in your accounting system so that it shows up on your balance sheet. That's absolutely the way to go. Obviously, we've talked about the fact that you need to look at your cash flow over the next 6 to 12, and I'd say even maybe up to 18 months, but certainly over the next 6 to 12 months, and be monitoring that effectively. And then obviously managing your cash flow, and then doing everything that you can to push out cash as much as possible. And to the extent that some of this stuff is really where you know that this is an issue, where you know that you need help with this and you don't have the wherewithal, then talk with someone who does. Talk with someone who can talk you through this stuff, maybe take a quick look at your financial statements, ask you some questions about what's happening with your company, and then maybe be able to help you put together a quick model. You'll know when it's time to hire a professional, because the pain will be there. But I encourage you to at least have initial discussions with professionals even before you hit that pain, because by the time it's painful for you, my guess is that it's already kind of done a little bit of damage.
Okay, great.
So I think we'll just kind of open it up for a Q&A at this point, if anyone has any questions.
Yes, that's what I was thinking. Anyone, feel free to type them into the question box to the right-hand side of your screen, and we can answer those for you. In the meantime, while we're waiting for questions to come in, we just want to say thank you so much to all of you for joining us for today's webinar. We really appreciate your time and hope that you found this useful. Again, if you have any follow-up questions, please feel free to email us or tweet to @earlygrowthfs #leancashflow. Our next webinar is November 12th, Startup Equity, What Founders Need to Know About Splitting the Equity Pie with Peter Stone from Hopkins and Carley and Glenn McCrae from Early Growth Financial Services. To register for this webinar and check out any other upcoming events, please visit our events page at earlygrowthfinancialservices.com. Thank you again for your time, and thank you so much to Cirque for an amazing presentation and webinar. We hope everyone has a great day and a very happy Halloween.
Thank you very much, Gina, and thank you all for spending a little bit of time with us. I hope this has been useful. It's been a lot of fun for me. So, and we hope to see you again in the future. And as Gina mentioned, happy Halloween to all.
Thank you, and thank you, Cirque.
Bye.
Bye-bye.